Hello and welcome to episode 41 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools like the merger arbitrage tool, check out insidearbitrage.com. Please take a moment to also like and subscribe to this podcast on whatever platform you might be listening on.
We are continuing with our new format by focusing on 4 key stories, including the merger of 2 timber REITs, a massive stock buyback at Synchrony Financial, insider purchases amid some fascinating developments at Sable Offshore, and Starboard Value taking a stake in Keurig Dr Pepper. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more details. Let's get this episode started by taking a look at some headlines in the deals in the workspace. Apollo Global Management just submitted another bid to acquire the pizza chain Papa John's International at $64 per share. It feels like Papa John's is in this endless cycle of always potentially being acquired. In 2018, the pizza delivery company first reached out to potential acquirers, asking for bids for the company. Trian Fund, Bain Capital, and CVC Capital actually made offers at the time, but the talks fell through. Talks were again sparked in June of this year, when it was rumored that Apollo Global Management and a Qatari investment firm, Earth Capital, had made an offer to take the company private. At the time, Papa John's was trading at around $48 per share, and the consortium made a bid in the low $60 per share range. There was always a possibility that Apollo could go for the deal alone, as Earth Capital needed to sort out financing. Looks like that's exactly what happened, and we'll see if a final deal materializes anytime soon. Papa John's is currently trading at $52 per share, roughly, and has traded as low as $39 per share since the June rumor. So if a deal is materialized at the $64 range, that's quite a bit of upside to be made.
Yeah, it looks like the deal needs to bake for a little bit longer before it's ready to be consummated, if you will.
Absolutely. Another interesting headline from this week was related to the possible takeover of Warner Bros. Discovery by Paramount Skydance, a situation we've discussed a couple times on this podcast before. This week, it was announced that Warner Bros. Discovery had actually rejected Paramount Skydance's offer for around $20 per share for being too low. But David Ellison is preparing a formal bid at a higher price, either through approaching shareholders directly or securing additional backing through a financial partner. For reference, Warner Bros. Discovery currently trades at $18.19, so even the $20 per share offer would represent a slight premium.
And Warner Brothers Discovery, after its merger with Discovery, had gone down quite significantly, and it's already rebounded quite a bit from those lows. Considering how long it took for Skydance to merge with Paramount, it feels like David Ellison is going to stay the course and try to get this deal done, which will probably be beneficial for both companies if regulators will allow it to actually go through. Switching to new M&A, we had a couple of interesting deals that are announced this week, including the merger of 2 timber REITs. A couple of decades ago, I'd gotten interested in timber companies as investments, where the value of the company could increase in 3 ways. These were companies where the assets physically grew each year as the trees in their forests reached for the skies. Then there was the potential for lumber prices increasing over time as demand for the construction of new homes increased. And then a third leg of the investment thesis was that the land these companies owned would appreciate in value as well. While the thesis sounded feasible, the reality turned out to be different. Rayonier, one of the 3 largest publicly traded timber REITs, was trading at $17 and change in October 2005, and it closed just under $25 last Friday. So not a whole lot of appreciation over that 20-year period. Yes, most of these companies were structured as REITs, and so a large part of their returns were from dividends and now just capital appreciation or the stock price appreciating. For example, Rayonier pays a dividend that works out to $1.09, or about 4.4% yield at current prices. In addition, the company also pays out special dividends occasionally, like the $1.80 it paid last December. Let us keep that special dividend in mind as it'll make its appearance once again. The two companies I used to track back in the day were Plum Creek Timber and Rayonier. Plum Creek was acquired by Weyerhaeuser 10 years ago in an $8.4 billion all-stock transaction.
That's a pretty large transaction. How does Weyerhaeuser compare to Rayonier in the present?
Weyerhaeuser is currently the largest private landowner in the US with over 10 million acres and sports a market cap of $17 billion. Rayonier, on the other hand, is much smaller with a market cap that is less than $4 billion. However, the company's size is going to double if the merger it announced last week closes by mid 2026. Rayonier is merging with Potlack Deltec in a $4.44 billion deal that brings together two timber REITs that together will still be less than half the size of the big kahuna in the space, Weyerhaeuser. Potlack Deltec shareholders will receive 1.7339 shares of Rayonier for each share of Potlack Deltec. The exchange ratio represents an implied price of about $44.11 per Potlack Deltic share, a very small premium of just 6% from the stock's last close. So that tells us that this is more a merger of equals rather than an acquisition of Potlack Deltic by Rayonier. Almost a million acres of the Rayonier Potlack Deltic lands are in the Pacific Northwest, where demand is strong for logs from private land because timber harvesting from federal lands has been declining for years. The rest of the land is in the US South, where an oversupply of pine trees has lowered log prices but made the region the most profitable place in North America to produce lumber.
So that's all fascinating, but what about tariff concerns? I've seen some recent news about tariffs regarding wood and lumber products. How might this impact the business?
Yeah, the tariff situation seems to be interesting. You keep hearing about on again, off again tariff all this year. The companies announced that they're merging on the same day President Trump announced 10% tariffs on imported lumber and wood products, and that was aimed at boosting US manufacturing. The measures are expected to hit Canada the hardest as it is the largest lumber supplier to the US. The new tariff actually adds to already higher duties on Canadian lumber stemming from a decades long trade dispute. In August, the combined duty rate for most Canadian producers rose to 35%, up from 15%. So, this is going to be quite significant for Canadian lumber companies, but this merger could help both Rayonier and Potlack Deltic compete with those Canadian lumber companies. The companies generate revenue from harvesting trees, selling wood products, and leasing or selling land for development. Besides timberlands, Potlack Deltic also owns mills in 4 different states. In September, lumber futures fell to the lowest level in 7 months as high interest rates and rising costs have strained consumers and reduced demand for new homes. Wood suppliers are experiencing what some call the worst market conditions they've ever seen, according to the US Lumber Coalition. Getting back to that special dividend I was talking about earlier, along with this merger announcement, Rayonier also declared a one time special dividend of $1.40 per share, payable in a combination of cash and Rayonier common stock. The dividend will be paid out on December 12th, 2025, to shareholders of record as of October 24th, 2025. So that's going to happen this week. The more interesting part of the story for us was that both Rayonier and Potlack Deltic have gained from growing demand from solar power developers, particularly in the South. They hold options and lease agreements for tens of thousands of acres with solar companies, earning rates more than 10 times higher than what they were making from growing pine trees.
Moving away from timber REITs into another newly announced acquisition, we saw the car retailing website TrueCar be acquired by Fair Holdings in a deal worth $227 million, or $2.55 per share. TrueCar currently trades at $2.45 per share, meaning the spread on the deal, which is expected to close either in the fourth quarter or latest by early 2026, is still around 4%. The spread is likely caused by the fact that Fair Holdings, an entity led by TrueCar founder Scott Painter, is reportedly still trying to finalize the financing to take the company private. Scott Painter founded TrueCar in 2005 and guided it through its IPO before stepping down from the business in 2015. But he will be returning as CEO once the deal closes. That makes sense. Over the last year, the stock is down about 50%, so I can see why he might want to step back in, take control of the company under a private setting instead of being responsible to shareholders, and then perhaps try to navigate it once again as the founder of this business.
Yeah, I remember seeing the TrueCar corporate headquarters on the freeway while driving down to LA, and I've used their service a long time ago, but they just fell out of relevance over the last several years. They're more of a used car and new car information service rather than a retailer of cars. But it'd be interesting to see if the spread on this deal increases or if it shrinks. At an annualized basis, I think the spread works out to over 9%, which is attractive.
Yeah, in the era of ChatGPT and even Google to some extent, it's not as if a lot of people are pulling up sites like TrueCars to directly compare prices when you could ask some sort of AI algorithm to do it for you.
Absolutely. Information is widely available at this point.
Mhm.
Switching gears to spin offs, Honeywell is finally getting to the final stages of its Solstice spin off, which we have covered briefly a couple of weeks ago on this podcast. As we mentioned, October 17, 2025 was a record date for the spin off of Solstice Advanced Materials, with distribution to happen on October 30th. Shareholders will receive one Solstice share for every four Honeywell shares, and essentially from Monday, Honeywell will be trading X spin-off. We still have two more spin-offs, including that of Honeywell Automation and Aerospace, that will happen in the second half of 2026. So long ways to go for that one. Getting back to Solstice, which was also the name of a Pontiac convertible that was pitched on the TV show Apprentice for folks who were watching that show a long time ago. The advanced material company will instead focus on Solstice refrigerant, which was the replacement for older planet harming refrigerants that were destroying the ozone layer. Beyond refrigerants, the company also makes materials used in medical devices, semiconductors, nuclear energy, and more. On the positive side, I was surprised that Honeywell is not loading the spin off with more debt. The net debt of just 1.55 billion gives them a chance to perform without being saddled with too much debt, which is often the case with spin-offs. Adjusted EBITDA margin of mid 20% looked better than I expected, but then again, it is adjusted EBITDA. Net margin is closer to what I expected and appears to be less than the other divisions. On the negative side, revenue growth was already low single digit and appears to be decelerating. The same thing is happening with net margin. Overall, I'm not as excited about the spin-off and I'll monitor it to see if it sells off sharply following the separation. Solstice will begin when issued trading on October 20th under the ticker SOLSV, and the regular way trading will begin on October 30th under the ticker SOLS.
Last week, we talked about rumors that Johnson & Johnson would make a bid for Protagonist Therapeutics, a company that focuses on rare blood disorders. This week, Johnson & Johnson announced that they would separate their orthopedics business within the next 18 to 24 months. What's especially interesting is that Johnson & Johnson specifically highlighted this orthopedics business to be the slower growing business, hoping to give its innovative drug and device operations more breathing room as the Trump administration pressures pharmaceutical companies to lower prices in the United States. Namal Nawana is appointed to serve as the worldwide president of this new standalone orthopedics business. He last served as the executive chairman and founder of Sephiros, a consumer diagnostic technology company, and the CEO of Alere, a leading point-of-care diagnostics company, until its acquisition by Abbott.
It was interesting to hear Johnson & Johnson mention that this orthopedics division is slower growing. You normally don't hear a parent company say that outright.
But maybe it might be a bit of a safer bet for investors, and that's what they're trying to market it as, because otherwise I'm curious as to who would buy a slower growing business right off the bat as a spin-off.
Good point.
All right, we'll move on to our stock buyback section of this podcast. This week, we came across a company that announced not one, but two buybacks this year, representing $3.5 billion in total buyback authorization. If you're using a credit card issued by a retailer like TJ Maxx, Dick's Sporting Goods, or Lowe's, You are using a card that was issued by Synchrony Financial with a ticker symbol SYF. The company, which was spun out of GE in 2015, has processed more than $1 trillion of purchases through its cards and is the number one in the US in terms of cardholders.
Yeah, I happened to come across this company in June 2023 when I attended the Value X conference in Vail. And it was one of two ideas that I picked from that conference, wrote about them, and invested in them. Synchrony stock has more than doubled since it was presented at that conference. And you shouldn't ask me what happened to that second stock I picked.
The $1 billion buyback that Synchrony announced this week was in addition to the $2.5 billion buyback they announced in April, which represented nearly 13% of their market cap at announcement. Over the last 4 years, the company has retired nearly a third of its shares outstanding, so pretty significant. And on top of that, it also pays a small dividend. The key risk with this business, as is the case with most credit card issuers, is a decline in consumer spending as well as an increase in credit card delinquencies.
So, what's happening in terms of credit card delinquencies now? Are we seeing any pressure on a certain end of the spectrum?
So, over the last decade, credit card delinquencies have actually been on the rise, and they hit an all time high in the first half of 2024. Continuing on into 2025, credit card net charge off rates, which measures the percentage of loans a financial institution expects to be unrecoverable, reached a series peak at the start of the year. While these rates have reduced slightly as of late, with more and more Gen Z young adults fully embracing buy now, pay later mechanisms, they started to represent a larger portion of credit delinquencies. Nearly 10% of credit card balances held by Americans aged 18 to 29 become 90 or more days late. In its early days, Synchrony had some fair exposure to these subprime borrowers, but about a year ago, the company started tightening credit standards and increasing rates in order to prepare for an expected cap on late fees that never quite materialized under the new administration. But with all the macro uncertainty, especially considering tariffs, Synchrony has not yet rolled back any of these changes, leaving the bank with a higher quality consumer base and enabling them to use capital to complete things like buybacks.
As you mentioned, the buy now, pay later stuff, I wonder when that comes home to roost.
I'm not quite sure. We've seen a lot of buy now, pay later companies actually go public as of late, too. So it seems to be the next new thing. I wonder at what time all this debt will catch up to the businesses themselves.
Yeah, both a combination of private credit, which JP Morgan CEO Jamie Dimon was referring to. If there is one cockroach out there, there are multiple cockroaches.
Yes.
And so maybe the same thing ends up happening with buy now, pay later. Never quite understood how that thing worked. Anyway, switching gears to insiders. Given that we are in the midst of earnings season, insider activity is usually quite muted, especially on the buying side of things. I think they keep selling hand over fist constantly, or 20 or 30 times the buys that we see on a weekly basis. But on the buying side, things do dry up quite a bit. Last week was typical until a big insider purchase hit after hours on Friday. We normally don't focus on 10% owner purchases if they don't have someone representing them on the board of directors. But we decided to make an exception in this case. The purchase was by a fund called Pilgrim Global that filed a Form 4 related to a nearly $15 million purchase of the oil and gas company Sable Offshore, ticker SOC. As you are aware, Sable Offshore has turned into a battleground stock for long and short investors, especially on finance Twitter, or FinTwit as it is known.
Yeah, we've been following Sable Offshore for quite some time, so we know why the company's a battleground stock. But do you want to dive into that a little bit more for any of our listeners who might not be as familiar with the business?
Yeah, but before we do that, we should probably cover what Sable Offshore does
Yes.
and why we have written about the company 5 times on Inside Arbitrage over the last 2 years. So long before the company became a FinTwit favorite, and famous investors like Lee Lu of Himalaya Capital and Phil Mickelson, the famous golfer, started positions in the company, we wrote about the company in May 2024 following an insider purchase by the CEO. Sable Offshore was formed through a business combination with the SPAC Flame Acquisition Corp. The company fully owns and manages the Santa Ynez unit, which includes all related pipelines, an oil and gas production unit, that was originally developed by ExxonMobil but was shut down in June 2015 following an accident with the pipelines owned by Plains All America Pipeline that caused an oil spill. While driving back to the San Francisco Bay Area from Los Angeles last month, we decided to take the scenic route back along the California coast to check out the Danish capital of America, Solvang, that friends had mentioned to me. As we drove north on Highway 1 approaching Santa Barbara, I could see offshore oil platforms that looked like they were part of the Santa Ynez unit. Sable acquired all of the Santa Ynez unit assets and pipelines in 2022, and the business combination with the SPAC officially closed in 2024. There was tremendous upside for the development and production of oil and gas at these facilities, though it was entirely contingent on gaining certain approvals from Santa Barbara County. And thus began a long saga of false starts and legal wranglings that have gone on for well over a year. In September 2024, Sable revealed that it had reached a conditional safety valve settlement with Santa Barbara County. A number of safety measures and refurbishments were to take place, and as a result, the county agreed to dismiss a pending lawsuit within 15 days of final installation of all 16 underground safety valves.
Yeah, the company's stock shot up about 39% in a single day on this news, but that victory was very short lived.
Right. By April 2025, the California Coastal Commission had issued multiple cease and desist orders to Sable Offshore and fined the company $18 million for conducting unpermitted pipeline repair work. The California Attorney General also got into the act, filing a lawsuit against Sable for continually failing to follow state laws and regulations intended to protect water resources. The Santa Barbara County District Attorney's Office went so far as to file criminal charges against Sable. So you have the civil lawsuit and now you have a criminal lawsuit. In light of the considerable roadblocks various California agencies are putting on Sable Offshore, the company is now contemplating transporting the oil using tankers instead of using its pipeline. What we know is that this method will be more expensive than the use of the pipeline that Sable repaired. The unknown part with this approach is whether California could do something to block this option despite the Santa Ynez unit being in federal waters. The Trump administration is clearly paying attention to these proceedings, and last Friday, the US Secretary of Energy actually tweeted about it. Getting back to the insider purchase, we covered it in great detail in our latest Insider Weekends article on insider arbitrage, but it is worth mentioning here that Pilgrim Global was involved in this situation all the way back when the SPAC Flame Acquisition announced that they were going to merge with Sable Offshore. They have been opportunistic buyers and, more importantly, sellers of Sable stock over the last 2 years. And just earlier this year, they sold $7.32 million worth of Sable shares in April and July. This latest purchase is most likely in violation of the short swing profit rule of the Securities Exchange Act that states that if insiders of a public company buy and sell, or on the other hand, sell and buy stock of the company within a 6-month period, they have to disgorge profits from those matching trades back to the company. Now, we don't know if Pilgrim Global violated the short swing rule because they were not aware of it. And we've heard that this has happened in the past where the insider bought and sold and was not aware that they couldn't do it within a 6-month period, or because they felt that the profit opportunity from buying at these levels was so large, they didn't mind giving back some of those prior profits. If all of this wasn't interesting enough, I was absolutely shocked when I saw the latest 13F filing by Pilgrim Global. But our listeners can either pull that filing up and take a look for themselves or read about it in an Insider Weekends article.
Absolutely. There's so much to cover about Sable Offshore. We've already covered a lot, but there's so much more to discover. So make sure to go check out the article. Moving on to the activist section of this podcast has started feeling a lot less like the Elliott podcast and perhaps a little bit more like the Starboard Value podcast, because we seem to be talking about the activists fairly frequently now. This week, it was announced that Starboard Value has built a stake in the beverages company Keurig Dr Pepper.
We last talked about Keurig Dr Pepper in the context of their proposed business split. Could you dive into that a little further?
Yep, just to recap, at the end of August, Keurig Dr Pepper announced that they wanted to create a global coffee giant to rival Nestle and Starbucks by acquiring JDE Peet's in an all-cash transaction worth $18 billion. After the acquisition closes, KDP plans to separate into two independent publicly traded companies, one being focused on the beverage market and the other set to become the world's #1 pure-play coffee company.
So why did they decide to acquire JDE Peet's specifically? And more importantly, which one do you like better?
That's a good question. I think the global coffee company has a lot more concerns to it, especially considering the tariff situation. There's been a lot of tariffs on Brazilian coffee beans, which seems to be a very big source for the business. And at the same time, there's been some issues with crop harvest as well. That being said, the reason they're acquiring JDE Peet's above all else is that Keurig Dr Pepper was formerly known as Keurig Green Mountain, a pure-play coffee company that was traded publicly from 1993 until 2015. It was taken private by a group of investors led by JAB Holding Company in March 2016 for $13.9 billion in cash. 2 years after being taken private, Keurig Green Mountain acquired the Dr Pepper Snapple Group in an $18.7 billion deal and was taken public again. JAB Holdings, a massive German firm that can trace its roots back to the 1800s, retained a major stake in the combined business that has since been taken down to a 4.4% stake. JAB had also once taken Peet's Coffee private and still holds a majority stake in that business, totaling over 68%. And the combined business I was referring to earlier is Keurig Dr Pepper. The synergies between the two businesses become a lot more clear with this JAB connection, and it could be that JAB is the one driving some of this change. JAB will hold nearly 5% in both follow-up companies after the acquisition and subsequent spinoff. Now this week, the Financial Times reported that Starboard Value has built a stake in Keurig Dr Pepper in the wake of its poorly received plan to acquire JDE Peet's. And that acquisition has hit the company's stock price hard. Starboard's been building a stake in the business since the August deal announcement and has been holding private negotiations with KDP's management and board in recent weeks. It's not as if Starboard can stop the deal because there's no shareholder vote for this acquisition and then subsequent split off. So their discussions with the business have been focused on improving execution and restoring investor confidence rather than the threat of a public campaign. So a lot nicer than Elliott might have done it, for example.
Yeah, they've always been known to be more collaborative with management teams. And unlike you, I actually like the coffee business better. Maybe it's just because I like Peet's coffee and I'm not a big fan of Dr. Pepper's products. Finally, to wrap up this podcast, let's talk about C-suite. There wasn't a whole lot of new C-suite appointments that we found particularly interesting last week, except for the appointment of a new CFO at Ardelyx. Ardelyx is a biotech company that we have in our model portfolio as a starter or tracking position because we noticed a $1 million insider purchase by the chairman of the company in January of this year. Ardelyx has 2 FDA-approved drugs for the treatment of irritable bowel syndrome with constipation and for the reduction of phosphorus in adults with chronic kidney disease. The part about the CFO appointment of Ardelyx that caught our attention is that Sue Hohenleitner comes to the company from Johnson & Johnson, where she was a CFO of the North American Innovative Medicine Division.
So it was nice to see that little update from Ardelyx, and with that, we will wrap up episode 41 of the Special Situations Report. What we've covered today is just a brief overview of all event-driven activity, so if you'd like to access a full look at the special situations landscape, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool. Check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.